Please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Pankaj Pandey, Head of Research at ICICI Direct, now joins us. Pankaj, good afternoon. Good to have you on the show. Let's discuss some stock ideas first from your house. NRB bearing, that's an interesting one. Take us through the rationale and your price targets here.
Hi, good afternoon, Anuj. See, on NRB bearings, we have a target price of 215. Last quarter, the company came out with very strong set of numbers, with top line growing by about 25%, margins expanded to about 19.5%, bottom line more than doubled to about 21 odd crores. Now, we like the stock because they've got a good exposure towards the entire auto space. Auto as a space contributes about 62% of their top line, and they're the market leader with 70% market share in needle bearing segment. And largely, they derive their demand from two-wheelers and four-wheelers and commercial vehicle segment. I think the prospects of all these three segments appear quite bright going forward as well, and which is why we expect that the company will keep doing well. The company is incurring a capex of about 50 odd crores and is available at a decent valuation of about 16.5 times. So going forward, we would expect this company to do well with a revenue growth of about 13 odd % and profit growth could be about 23 odd %. And with better growth and decent multiples, we like this stock as it is a good proxy on the overall auto play.
Okay, that's one pick. Pankaj, good afternoon. You also seem to like TCI Express. Now, the stock has had a decent run. It's done about 70–75% in the last 1 year. What are the fresh triggers that could take it higher?
Hi, good afternoon, Surbi. I think TCI Express within the entire logistics space appears to be quite attractive from the fact that it is asset light in terms of business model. 95% of their fleet is on a contractual basis. They have got one of the highest ROCs in the entire logistic space at about 35 odd %. Now, prior to FY16, this company was growing in the range of about 6–7 odd % in line with the industry growth rate. And after that, the company got demerged. And post that, the company started investing. So after that, they invested about 96 odd crores, and the growth has picked up to about mid-teens, 15–16 odd % compared to the industry growth rate of about 6–7 odd %. Now, what the company is looking to do is that in the next 5 years, they are looking to do capex of about 400 odd crores till 2022. Now, because of this capex, their capacity will get expanded from about 7.6 million ton to about 14 million tons. Now, largely bulk of this capex is going to happen in sorting centers or towards procuring handling equipment. And so the basic DNA of the company does not change in terms of being asset light. And overall, that should lead to good top line growth of about 16 odd %. We expect a decent margin expansion also to about 12 odd %. Last quarter, they had clocked about 10.5 odd %. And bottom line growth is expected to be fairly good at about 27 odd %. Like you said, the stock has done well, but I think the strong visibility in the next 4–5 years, and it's a good play on the overall logistics being implemented, and then e-way bill also making its way going forward. So from that perspective, this stock looks quite attractive to us with a target price of about 660.
Okay, Pankaj, stay on. We'll discuss a couple of more ideas with you. For now, let's see if there's a 3 p.m. move on the bank nifty today. It doesn't look like that. At least for now, things are stabilizing. So if you thought, maybe it was going to go below 25,300, that's not happening. In fact, now a bit of a stability in the green now is what we have on the bank nifty, and of course on the nifty at about 34 points higher is what we have. So looks like the damage for the day at least is over. Pankaj, what about your final pick, KEC International?
So we like the entire infra space. In fact, the government's focus on infra in the next 4–5 years is going to be substantially high. In fact, the government is looking to do overall capex of or drive overall capex of about 48 lakh odd crores. And I think this company, if you look at, would be a has been a beneficiary of it and will continue to benefit from it. Now, if you look at prior to FY16, a company like this used to get orders to the tune of about 7,000 to 8,000 odd crores. Now, what has happened now is that in the last 2 years, the order inflow has picked up quite well. In fact, in the first 9 months, the order inflow has been upwards of 31% to 11,300 odd crores. In addition to that, they've got an 11th status of about 4,000 odd crores. So this year, the order book could be about 15,300 odd crores. We expect a similar kind of order flow in FY19 as well. Now, overall, from a margin perspective also, we expect a slight improvement in the margins. But what we have seen is that with strong order inflows and good execution, I think the growth in the top line would be fairly robust. And same would be the case in the case of bottom line. And on the debt equity side, the company has managed its working capital situation quite well. So their debt equity ratio on a forward basis would be below 1, so which is quite attractive with a profit growth of nearly 20 odd percent and top line growth of about 18 odd percent. We feel this stock though has done well, but will continue to do well because order inflows across all most of the EPC players, if you look at, has been quite robust for the next 1 year. So from that perspective, I think this stock will continue to benefit along with other EPC players.
Okay,